In just 30 minutes, the financial world was rocked as global markets hemorrhaged $6 trillion in value, with gold and silver taking the hardest hits. Gold plunged nearly 8% intraday, while silver collapsed 12 to 14% in a matter of minutes. Investors around the world were stunned as decades of gains in precious metals seemed to evaporate in the blink of an eye. What triggered this unprecedented sell-off? The answer lies in a sudden shockwave from the Federal Reserve, sending ripple effects across every market and shaking confidence in assets once thought untouchable. Welcome back to Economy Historian TV. Today, we re-diving deep into why the Fed's recent moves caused the largest precious metals crash in weeks, wiping out trillions and upending market expectations. Over the past decade, gold and silver have enjoyed a historic bull run. Gold soared to all-time highs above $5,300 per ounce, while silver surged past $100 per ounce, setting records and fueling investor optimism. But as we'll explore in this video, those gains were suddenly under siege. We'll break down exactly what happened, why the Fed's action sent metals tumbling, and what this could mean for the global economy moving forward. Stick with us as we uncover the mechanics, the numbers, and the story behind this historic $6 trillion wipeout. In a matter of minutes, the precious metals market experienced what traders are calling a flash crash, a sudden, sharp, and almost unbelievable drop in prices. Gold, which had been trading steadily near all-time highs above $5,300 per ounce, fell as much as 8 to 8.2% intraday, wiping out billions of dollars in market value almost instantly. Silver suffered even more dramatically, plunging between 12 and 14% as traders rushed to liquidate positions and protect themselves from mounting losses. The velocity and scale of the drop left many investors stunned, with screens flashing red across trading floors from New York to London to Hong Kong. It is important to note that this was an Otis Tia collapse caused by fundamental shifts in supply or demand. Gold and silver themselves remain scarce, industrial demand is strong, and geopolitical tensions continue to support their status as safe haven assets. Instead, the crash was largely driven by forced liquidations and margin calls. Many traders and funds holding leveraged positions in these metals were suddenly forced to sell to meet margin requirements as prices began to slip. Once the selling began, algorithmic trading and automated stop-loss orders kicked in, accelerating the decline in a feedback loop that magnified the losses far beyond what human traders alone might have caused. The $6 trillion wipeout across global markets underscores how interconnected and sensitive financial markets have become. Even small changes in investor sentiment or policy expectations can trigger massive moves in highly leveraged assets. In the case of this crash, the Federal Reserve's unexpected signals about future interest rates and monetary policy created a wave of uncertainty. Traders interpreted these signals as potentially hawkish, which strengthened the US dollar and reduced the appeal of dollar-denominated metals like gold and silver. As the dollar surged, pressure mounted on leveraged positions, triggering cascading liquidations that rippled through ETFs, futures contracts, and derivative markets. In essence, the market reaction was less about the intrinsic value of the metals themselves and more about the fragile dynamics of a market operating with high leverage and automated trading systems. What appeared to be a sudden collapse was actually a systemic reaction to policy signals and structural vulnerabilities, showing how quickly even the most historically stable assets can experience dramatic swings when sentiment shifts and forced selling takes over. This event serves as a stark reminder of the risks inherent in modern financial markets and sets the stage for understanding why the Fed's moves had such an outsized impact on gold and silver. The recent crash in gold and silver cannot be fully understood without looking at the Federal Reserve's policy signals and the expectations surrounding its leadership. Markets had been bracing for potential changes at the Fed, especially with speculation that Kevin Warsh might take over as the next Fed chair. Warsh is widely viewed as a more hawkish policymaker, favoring tighter monetary policy and a stronger focus on controlling inflation rather than continuing the easy money policies that dominated previous years. This anticipation alone created a wave of uncertainty, prompting investors to reevaluate positions in assets sensitive to interest rates, including gold and silver. Historically, gold and silver thrive in environments of loose monetary policy and low interest rates. In 2025, for example, the metals experienced a historic bull run fueled by Fed easing and massive liquidity injections into the market. Investors poured money into precious metals as a hedge against inflation and currency devaluation, driving gold above $5,300 per ounce and silver past $100 per ounce. The market had come to expect continued support from the Fed, and much of the gains were priced on the assumption that these policies would remain in place. When whispers of a more hawkish Fed chair emerged, that expectation shifted almost overnight. A key mechanism behind the sell-off was the strengthening US dollar. A more hawkish Fed typically signals higher interest rates or tighter monetary conditions, which tend to attract foreign capital into US dollar assets. As the dollar strengthens, the appeal of non-yielding assets like gold and silver diminishes. Investors holding dollar-denominated gold and silver suddenly face lower potential returns compared to bonds or other interest-bearing assets, creating incentive to sell. This shift in sentiment was compounded by leveraged positions, where even small movements in price could trigger margin calls and forced liquidations, further accelerating the sell-off. In addition, the contrast with the prior year's liquidity-driven rally magnified the reaction. During 2025, every Fed signal for continued accommodation was interpreted as a green light for buying more gold and silver. ETFs, futures, and derivatives all saw inflows as investors chased gains in a market fueled by expectation of low rates and abundant liquidity. The pendulum swung quickly, however, when the market began pricing in potential tightening. The sudden reversal caught many off guard, triggering rapid de-risking across portfolios. It's also worth noting that this was not purely a domestic story. A stronger dollar affects global demand for commodities priced in dollars, including gold and silver. For international investors, a rising dollar makes these metals more expensive in local currencies, further reducing demand and putting additional downward pressure on prices. Combined with the fear of a more hawkish Fed, the market saw a perfect storm. A currency effect, policy uncertainty, and leveraged positions all converging to create one of the most dramatic short-term drops in precious metals in recent memory. Ultimately, the Fed A&S policy signals demonstrate how central bank expectations can move markets even without any fundamental change in the underlying assets. Gold and silver remain scarce, industrially useful, and historically valuable, but in modern markets, perception, leverage, and liquidity can drive prices far faster than supply and demand alone. The anticipation of a hawkish Fed chair and a stronger dollar set the stage for the $6 trillion wipeout, highlighting just how sensitive markets have become to monetary policy in a post-liquidity era. The staggering $6 trillion loss in global market value during the precious metals flash crash can be better understood by looking at the mechanics of modern financial markets and how price movements multiply across holdings worldwide. When gold, for instance, was trading near $5,500 per ounce, an intraday drop of over 8% translated into a massive decline in the total market capitalization of all gold holdings. Considering the total value of gold above ground is estimated at roughly $13 trillion, even a single-digit percentage drop wiped out hundreds of billions of dollars almost instantly. Silver, which had climbed to all-time highs near $120 per ounce, experienced an even sharper decline of 12 to 14%, further amplifying losses because silver's market is smaller and more volatile than gold's. The cumulative effect across both metals, combined with leveraged positions and derivatives, explains how losses rapidly scaled into trillions. A critical factor behind the magnitude of this crash was forced selling. Many investors and institutions hold leveraged positions in precious metals through ETFs, futures contracts, and derivatives. When prices start to fall, these leveraged positions face margin calls, requiring traders to either add cash or liquidate holdings. In this case, a cascading wave of liquidations began almost immediately as participants scrambled to meet margin requirements. Once selling started, it triggered algorithmic trading systems, which are programmed to sell automatically when certain price thresholds are breached. These automated systems multiply the speed and intensity of the decline, creating a feedback loop where falling prices lead to more selling, which leads to further price drops. The impact of these dynamics is compounded by the global interconnectedness of financial markets. Gold and silver are not traded in isolation. They are part of a complex web of ETFs, futures, options, and other derivatives that span continents. A significant drop in one market triggers valuation adjustments in related instruments, causing investors to rebalance portfolios and reduce exposure across multiple asset classes. For example, when gold fell sharply in New York trading hours, positions in London, Hong Kong, and Shanghai were immediately affected, as funds adjusted for risk and leveraged exposure. This interconnection magnified the overall market impact, contributing to the enormous $6 trillion figure in lost value. Additionally, sentiment plays a crucial role. Investors often react not only to price changes, but also to the perception of systemic risk. The sudden drop in metals triggered panic selling in related markets, as traders assumed that a broader correction could follow. This behavior, combined with the mechanical effects of leveraged positions and algorithmic triggers, turned what might have been a smaller correction into a historic market event. In essence, the $6 trillion wipeout wasn't just about gold or silver losing intrinsic value. It was about the structure of modern markets, leverage, algorithmic trading, and global interconnections. Each percent move in these high-value assets ripples across countless portfolios, ETFs, and derivative contracts, exponentially magnifying losses. The crash demonstrates how quickly systemic factors can escalate a market movement into a catastrophic event, showing that in today's financial ecosystem, price swings in even safe haven assets can have monumental real-world consequences. Before the dramatic crash, gold and silver experienced an extraordinary rally that set the stage for the massive $6 trillion market disruption. One of the main drivers behind this surge was dollar weakness leading up to 2026. The US dollar had been under pressure for months due to concerns over trade deficits, slowing economic growth in certain sectors, and expectations that the Federal Reserve would maintain an accommodative monetary policy. A weaker dollar makes dollar-denominated commodities like gold and silver more attractive to international investors because they effectively become cheaper in other currencies. This dynamic fueled buying from both institutional and retail investors, pushing prices to historic highs. Another significant factor was geopolitical tension, which historically drives safe haven demand. Rising conflicts, trade disputes, and uncertainties about global economic stability led investors to seek refuge in tangible, long-term stores of value. Gold and silver, often seen as insurance against political and financial instability, benefited heavily from this environment. Every headline about global uncertainty seemed to reinforce the perception that holding precious metals was a safer bet than cash or other riskier assets, encouraging both long-term accumulation and speculative buying. In addition to macroeconomic and geopolitical drivers, massive ETF inflows and central bank accumulation in 2025 played a critical role. Exchange-traded funds tracking gold and silver attracted record inflows, with investors funneling billions into ETFs as an easy way to gain exposure to the metals without directly owning physical bullion. Meanwhile, central banks continued to add to their reserves, particularly in emerging markets, as part of broader strategies to diversify away from the US dollar. The combination of retail, institutional, and central bank demand created extraordinary upward pressure on prices, helping gold break past $5,300 per ounce and silver exceed $100 per ounce. Silver, in particular, also benefited from industrial and supply constraints heading into 2026. Unlike gold, silver has substantial industrial applications in electronics, solar panels, and various manufacturing processes. At the same time, mining output had not kept pace with growing demand, resulting in tighter supplies. This imbalance amplified the price rally, as investors recognized that both physical scarcity and industrial demand could drive further gains. Speculators and long-term investors alike were drawn to silver as a commodity with both financial and practical value. Together, these macro drivers created a perfect storm for the metals rally. Dollar weakness, geopolitical uncertainty, heavy ETF inflows, central bank buying, and silver's supply-demand dynamics combined to generate unprecedented bullish momentum. This environment not only lifted prices to record levels, but also set the stage for the extreme volatility that followed. When the Fed signaled potential policy tightening, all of these forces reversed sharply, highlighting how quickly market sentiment can shift in response to macroeconomic and policy catalysts, and why the metals market became vulnerable to the historic $6 trillion wipeout. The crash of gold and silver reveals a striking reality about modern financial markets. Even assets traditionally considered safe havens are not immune to extreme volatility when sentiment and liquidity dynamics take over. Gold and silver have long been seen as stores of value, hedges against inflation, and protections against geopolitical uncertainty. Yet, during this flash crash, both metals plunged dramatically despite no fundamental change in supply or demand. This shows that in today's highly leveraged and interconnected markets, investor psychology, margin pressures, and liquidity conditions can outweigh traditional fundamentals, at least in the short term. A major factor amplifying the crash was margin calls and over-leverage among commodities traders. Many hedge funds, institutional investors, and even retail participants hold positions in gold and silver with borrowed capital, expecting gradual gains. When prices began to fall sharply, brokers required traders to either deposit additional funds or liquidate positions to cover losses. This triggered a chain reaction. Forced selling led to further price drops, which in turn caused more margin calls, creating a self-reinforcing downward spiral. Automated trading algorithms intensified this effect, executing sell orders at lightning speed once certain thresholds were breached, accelerating the collapse. The metal's dramatic fall underscores how modern markets are driven as much by structure and mechanics as by actual economic fundamentals. While gold and silver remain scarce and industrial demand for silver remains strong, their prices can be temporarily decoupled from these realities during periods of stress. The crash also highlights the systemic risk posed by leverage in commodities trading. High levels of borrowed capital amplify both gains and losses, creating potential for catastrophic movements in a very short time. Ultimately, this event serves as a stark reminder that safe haven does not mean invulnerable. Even the most historically stable assets can experience rapid, large-scale declines when market participants are forced to react simultaneously to liquidity pressures, policy signals, and shifting sentiment. For investors, the lesson is clear. Understanding market mechanics, leverage, and liquidity risks is just as crucial as assessing fundamentals, particularly in a financial ecosystem where trillions can vanish in minutes. This crash has not only shaken confidence in precious metals, but also exposed the fragility and speed of today's global markets, setting the stage for cautious trading and heightened awareness moving forward. Gold reached all-time highs above $5,300 per ounce, while silver soared past $100 per ounce, breaking records and fueling investor optimism. However, a sudden dollar rebound combined with hawkish Fed expectations triggered a sharp reversal, sending both metals tumbling. In just minutes, global markets saw an estimated $6 trillion wiped out as leveraged positions were liquidated, and panic selling swept across trading floors, highlighting the extreme volatility and sensitivity of today's financial markets. The gold and silver crash offers a powerful lesson about how modern markets operate. Risk sentiment, liquidity pressures, and central bank narratives can move even the most prized assets far faster than fundamental supply and demand. What happened in those 30 minutes wasn't tea about a sudden shortage of metals or a collapse in industrial demand. It was a reflection of the fragile, interconnected, and highly leveraged financial system we operate in today. Investors saw trillions wiped out, and the speed of the sell-off underscores just how quickly confidence can shift when expectations about the Federal Reserve change. This event raises some critical questions for both traders and long-term investors. Is this just a sharp correction in a continued bull run, or could it mark the beginning of a prolonged bear phase for precious metals? And looking ahead, what will the Fed do next? Will it lean toward easing, providing liquidity to calm markets, or tighten further, potentially prolonging the volatility? These are the key factors that will determine whether gold and silver can recover or face more sustained pressure. We want to hear your take. Head to the comments and let us know which scenario you think is most likely. Will metals rebound strongly after this sell-off? Will we be entering a long-term bear market for gold and silver? Or could this crash spark contagion across other asset classes, spreading losses even further? Don't forget to like this video and subscribe to Economy Historian TV for in-depth analysis, charts, and updates on market-moving events. Your insights help us explore these complex dynamics and bring clarity to the chaos of global financial markets.